Welcome. You are listening to the Willamette Investors Network Multifamily Show. We are a nationwide network of investors, syndicators, and industry professionals that invest in real estate together. We believe that investing is a team sport, and our goal is to connect you with the people, experiences, and education that will help you along your journey to multifamily success. Welcome to the Win Multifamily Show. My name is Daniel Holmund. Today we have with us Angelo Christian. Angelo Christian is an investor, entrepreneur, and author. He's noted as one of the top producing loan originators in the country. As CEO of Christian Financial, Angelo has helped tens of thousands of people with influential coaching, real estate university, and wealth management and mortgage banking techniques. Angelo, welcome to the show.
Hey, Daniel. Thank you so much for having me. I'm really honored and privileged to be on your show today and excited to talk about multifamily. Yeah,
it's great to have you here. I've seen some of your videos that are on YouTube, and you've got a good number of topics that are up there. So definitely check out your YouTube channel.
Thank you. Thank you. That means a lot to me. We work very hard to produce great content for all of our followers. We've had the channel up for about 4 years and about 53,000 subscribers right now. And so
nice.
Just basically pouring in the wealth of my knowledge that I've been working on for the last 2 decades to share that information out to the world. So.
Excellent. And can you tell us, what do you do and how do you help multifamily investors?
Yeah, absolutely. So we're a nationwide private money lender. We do agency funding, FHA, commercial, residential, industrial. We have a multitude of different investors that we work with, from family offices to insurance companies, REITs, for placement for debt and equity for investors, right? And so we have offices. Our headquarters is here in Houston, Texas. We have an office in Miami, one in Los Angeles, and we lend nationwide all over the country with multifamily, whether it's ground up construction, bridge loans, existing, stabilized. We even lend international on some deals, and we can do anything from, extreme hard money to agency funding, just based on, like today I was working on an $11 million deal for a bridge loan this morning. And then last night I was working on a $50 million, 280 unit multifamily ground up construction to seek debt and equity. So it just, it depends on what the investor is trying to do. So we typically work with seasoned professional investors that have experience with funding multifamily. We also do senior living is a huge thing for us right now. Also, student housing, and another hot thing that's really hot in Texas and Florida right now is mobile home parks. So anything where there's a nice yield to it with a attractive entry with low risk, we love anything real estate related.
Wow, those are all great topics. This show is all about multifamily, and we tend to focus directly on it. But I love the topic of mobile home parks because I think that is a great area for investors.
It is. It really is. We just did a deal in South Texas for 100 units on a mobile home park. The cap rate ended up being like 19%.
Oh my goodness.
And so, it's the developer, he's building the whole thing, so his costs are so low. And what's interesting about it is that area, they just built a refinery there. And there's the original population of the area was only 1,400. So this huge refinery came in, and they added like 1,300 new jobs. They had nowhere to live. So he just threw out this 100-track mobile home park, whipped it out. And it's crazy. He bought these mobile homes on the cheap, and he fixed it up, made it look really nice. But anyway, we gave him the funding for the land, the construction, the whole deal, right? And so it was an awesome package. So it just depends. But yeah, multifamily, we love it. We do all different types of multifamily funding. So I love any questions that you have, especially right now during COVID. A lot of stuff has changed with multifamily funding. So it's a great topic to talk about right now.
Yeah, let's dig into it. I want to kind of hear how you evaluate maybe a typical value add multifamily deal. And then I also want to hear a lot about construction. New construction is an interesting topic, particularly as price per square foot are rising in a lot of metro areas. It makes a lot of sense to be looking at ground up construction in a lot of different metros.
That's right.
And so let's start with the value add deal. Do you have a recent value add deal that you can walk us through? And how do you decide to partner with a particular person when they're working on a deal?
You mean if we're giving the financing?
Yes, the financing.
Yeah. So I mean, so a lot of the times what we do, I'll give you an example of one that we just completed here in Houston. It was a 52-unit multifamily purchase, and the purchase price was $2 million, and the ARV was $5 million, and it needed about $900K in rehab. Okay. So what we do on something like this is that we'll normally take this down with hard money. Okay. And so, because we could do hard money on our left side and then banking institutional financing on the right side. So we can give 100% LTC on the hard money because he has, 35% embedded equity off of the ARV. So the way that we look at it is, okay, how strong is the sponsor? The first question you asked about the underwriting. So the sponsor has a $25 million net worth. He has $2 million of cash, and he has probably 100 properties in his portfolio, right? So we have a very strong sponsor. Sponsor looks good. It's not his first time doing a deal. That's the first question, is how good is the sponsor? Second question is that if this thing goes into default, can I go in there and fix this up and do it myself? Do I like the location, right? Because we have developers, we have builders, contractors. So that's the second question is it in a metropolitan, urbanized area? We don't really like to lend in rural areas. We're not a rural lender. So that's the second question is that this is in Houston, Texas. And what's the exit strategy, right? What's he going to do with this? Because as a value add, as a bridge, are we going to be the takeout lender on a perm loan with the agencies, or is he going to flip this thing, right? So, and the interesting thing about this particular deal is he already had an LOI from the University of Houston to purchase the property once he fixed it up. So he had his exit strategy already in place, right? So we have strong sponsor, great location. I like the deal. I could do it myself. He found it first. So, and then we have an exit strategy. So he'll be in and out of this thing in a year. It's going to probably take him 8 months to 10 months to complete the rehab. It's a huge rehab job. It's huge. So
it's a deep value. Are they taking it down to studs or is it?
No, it's not. I mean, it's just that so right now it's just, if you saw the pictures of it, a lot of it, so half of it's kind of gutted, but they're not taking it down to studs. It's going to be because of the permitting, because it's in the city. The permitting is really tough in Houston. I don't know. What city are you in? Where are you?
I live in Portland, Oregon, but
Oregon.
actually both of the properties that I own are in Houston.
Oh, really? Okay.
Yes.
Okay, cool. So, anyway, we're giving him it's a 1-year bridge. Give him a hard money loan because of the strength of the sponsor, the equity spread. He can get 100% financing. It's a hard money loan, so he's paying 12% interest, and we're giving him all the money for the rehab. He only pays interest on his drawdowns on the interest when he's actually drawing off of the line. Mm-hmm. Then he's going to flip it to the University of Houston. If he doesn't end up doing that, we can roll it over to a perm loan. Mm-hmm. Once it's stabilized to the agencies, we can take him out with Fannie Mae. But that's how we'll evaluate a deal. Our core requirements is we'll normally put a seasoned investor that wants to do a value add with a hard money loan on the takedown, and then we'll roll him over to a perm loan after that, or if he's going to flip it. And we can also give extensions on the hard money loans, 2 6-month extensions. But that's the cool thing about our company, whereas we can give the hard money and be the takeout lender, whereas a lot of lenders are just a hard money lender, or they're just a bank or a permanent lender. They don't offer all of it. And so we can come in at the beginning and also in the interim and on the end. And that's a really cool thing about our company, how we're structured.
Great. And I noticed that you mentioned Fannie Mae or Freddie Mac, and their requirements have changed quite a bit here in just the last couple of weeks. Does that alter this particular plan at all, or maybe other future plans you're looking at?
So basically, that's a good question to talk about, Daniel. The thing is that the changes, like we did yesterday, a refinance on it was actually right at $1 million, Fannie's minimum loan requirement. For a refinancing, we're taking our client off of a hard money loan that we put them on a year ago to Fannie. The biggest change, guys, out there with the agencies right now is they're requiring anywhere from 6 months to 2 years of interest reserve.
Yep.
So huge deal there. So I did a deal last week, and it was 2 years of interest reserve for the payments.
Mm-hmm.
So because we don't know what's going to happen, right? We don't know. I mean, is the tenant going to be able to make the payment? I got a lot, even my own personal REO, probably about 50% of my tenants are calling us saying they can't make their payments. So they got to choose either buy food or pay the rent, right? Mm-hmm. And so that's one of the biggest things. Also, LTVs are getting cut. So before, you're more liberal, you go to 80%. And now lenders are, they're pulling it back. 65% is the magic number for LTV because, we're seeing that all across the board. I'm not saying you couldn't get a deal done at 75 or 80%, but you better be a very, very strong sponsor, have a very compelling case. But a lot of the lenders that I'm seeing right now, I mean, it's at 65% LTV or less.
Yeah, I'm with a team right now, and we were best and final for a 84 unit down in Bradenton, Florida, and
great area.
It was Fannie, and they came back to us and said, "Hey, rather than a 75% loan to value ratio, we're going to do 65 now.
Yeah.
Your interest rate's going from 4.25% to 5%, and we're requiring 12 months of mortgage interest put aside in an escrow account."
Yeah.
And we looked at it and went, okay, well, we're going back to our seller and renegotiating.
Yeah.
So we're in limbo now on that particular deal because we need to get the seller down if we want this to make sense to our investors.
Right.
So it's definitely interesting times. Are you seeing that with a lot of deals that are out there, or how many deals are still going through in the mortgage world right now?
It's a great question. So I can tell you when the whole COVID thing first broke out, it almost seemed like the world was coming to an end. Like it was, I mean, pretty much 90% of the investors or underwriters, I got to stop lending right now. Right. And it seems like, I guess after Easter, it seems like it's kind of calmed down a little bit, the panic. But then they just added all these overlays onto the guidelines, right? LTV adjustments, interest reserve. And I don't blame them. I understand what the rationale is. It's just that, what's happened is, I'll tell you, like, we probably just in the last month, Daniel, probably have about 100 million in loans just frozen. Mm-hmm. Don't know what to do with them. Just kind of just sitting there telling people, let's just check back in the summer. I don't know what else to do either. And I'd say it's affected probably about 80% of our business right now. Just because, I mean, everything, like you said, has to be retraded, and some sellers are not they're not going to do it. Like, hey, I'll just wait. I don't want to deal with that. And so yeah, it's definitely put a wrench on some deals. Obviously, some people are still moving forward, and then ground up construction. You said you wanted to talk about that. That's a great topic because one of the biggest things that I've seen in multifamily and commercial in general, I'm sure you can appreciate this because it seems like your fund or your group is actively pursuing. There's all these investors out there chasing yield, and there's only so many properties out there, right? And what happens, and you see this with a lot of the larger funds or REITs or private equity groups, is that they have very tight standards or covenants for their fund to purchase properties, and they're loosening their standards, or they were the last 18 months, because there's not that much out there, right? So how many 88 units in Bradenton are there? And how much capital is out there? So where a lot of our investors have done is start to ground up construction because they can't find the deals, they can't find the opportunities. So they're creating their own opportunity per se, right? They've either partnered with a builder or they are the builder, which we're seeing a lot of builder developers self-build because they can control the deal, get the land where they want it, and then design it the way that they want to and control the cost. And it's been working very well. Up until March 15th, it was on fire for us. That's all we really mainly catered to. On the multifamily was ground up construction. And we do this nationwide, by the way. So, so we have a private equity where we give the debt up to 75% LTV, and we can give equity too. We have JV partners that can come in with the equity if the sponsor just puts 10% down, and our equity partners will cover the rest. And it was smoking because, you know, hey, I can build my own build to suit and have a nice deal, get a better cost per door, make it look the way I want to. And so,
where are you seeing the hot spots in the country for ground up development versus multifamily or value add? Are they starting to separate out into locales, or are they more or less distributed around?
So I'll tell you, it's a great question. City-wise, we were doing a ton of business in Orlando, Tampa.
This is ground up construction?
Yes, sir. Yes, sir. Yeah. So Houston, San Antonio, Austin, the West Coast, Arizona, Scottsdale, Phoenix. We're a little bit in the Carolinas is where we see a lot of the major metropolitan areas where we're just getting the calls from funds probably like your fund, like, hey, what do you got on the private equity side, ground up construction, you know, with good terms, non-recourse. That's another thing too, is that these loans are non-recourse. And then another key thing here, Dan, I don't know if you're aware of this, but FHA just removed, prior to, you know, this whole COVID thing, they're ruling on using valuation for refinance after the property is completed. You can actually use the current market value to refi. So what a lot of the funds are doing is they're using private equity for the construction loan, and then they're refining on the appraised value once it's completed, and they're cashing out to pay off their investors because they can go to that 85%, you know, LTV. And I'll give you an example. Let me tell you one that we did. So it was a $50 million, 280 unit in Katy, Texas. And when they were done with it, their valuation was like 68 million, and their first lien was for like 32. Okay. So when they were done with it, they're refinancing with FHA and being able to get a loan for like 57 million. Okay. So that way, because they had JV partners that gave the equity, so they're refinancing and paying off those partners as opposed to waiting 5 years or whatever on a preferred return.
Yeah, that's great.
They're cashing them out right there.
That's great.
Yeah, it's a very good strategy because we do FHA ground up construction. It's a great program. The only thing is that, as you may know, that FHA ground up construction is a little bit more cost intense. Those are expensive loans. It's like a CMBS loan. They're a little bit more expensive. But, you know, so that's another strategy that more of the sophisticated funds are doing to kind of get around to reduce the cost. That's
a great way of, for your investors, increasing their velocity of money. Because if you can get into that deal and get your money back out of it and still have your equity share within it, then you have a pretty deal. It's a great deal for you. Right. All right. And so COVID then has been changing a lot of the lending requirements here recently. Have you seen, actually, I wanted to go back. You mentioned recourse debt. Have you seen a lot of adjustments in recourse versus non-recourse during this COVID time? Yeah, I have. They're going to more of a full recourse. Full recourse loan because they want a strong PG on there because, again, we don't know what's going to happen. That's what underwriters are saying. I don't know what's going to happen, so I need you to personally guarantee this deal. You know, and one of the things that private equity, what's better than, you know, you go down to your bank to get the loan, you're going to have to be a personal guarantee. The beauty of private equity, one of the strong things is that normally in a normal environment, they're non-recourse, so it makes it very attractive, right? And if you can get equity in addition to debt, it limits the sponsor's exposure. But even right now, even on private equity, they're wanting some type of, clawback or personal guarantee just to protect, the investor. What we've seen
a larger appetite for bridge in the last 3 weeks than I've ever seen before. I've seen a lot of investors come into the marketplace. Now the rates are higher, but they're more for value add, short-term 1-year notes. But it seems like a lot of balance sheet private lenders have come into the marketplace wanting to make these bridge loans at low LTVs, 50, 60% LTV, 10 to 12% rates. I mean, there's points on there, 3 to 4 points, but there's a lot of that right there. So if you're looking to do value add type deals, that is still really, really hot right now. Hard money, anything that's doesn't have a lot of banking or institutionalized covenants, those loans are still very much like, we're very active with our balance sheet lending for hard money type deals. So whether it's multifamily, like we did one in Pennsylvania 2 days ago, and it was a $300,000 takedown, and he was adding that one. I mean, they were adding units there. It was a 7-unit, and they're adding 2 units, and the rehab was like $400,000, and we're giving a 1-year bridge. And basically, he's like, "Look, man, no other lender. I'm calling you. You're in Houston. No other lender is even going to touch this deal right now. Everyone is shut down." I was like, "Yeah, we'll fund it, and we're going to fund you at 65% LTC on a 1-year bridge loan." He's like, "Yeah, let's do it, man. Sign me up." So bridge loans are still even stronger right now. So if you're out there, if you're an investor, you need bridge financing, please reach out to us. We'd love to help you.
Yeah, it's good to know. In terms of other types of loans, are you seeing any activity in? Well, let's go over to mobile homes actually and change topics a little bit. You mentioned that mobile home deals are still continuing right now. Is there a big difference between the type of activities that you're seeing in mobile home versus other sectors?
So as of today, the LTV, the terms and the personal guarantee requirements are the same, right? 65%, LTV maximum. The thing that I think that's interesting about the mobile home parks is, and it depends on where you're going to do it at, right? I mean, we had you mentioned Bradenton, which is a hot area actually for mobile home parks. There's a lot of senior retirement centers or areas around there. And so I think that the thing is that the cost of living to live in a mobile home is obviously much cheaper. And if you do it right, like in a destination area or a retirement area or a workforce area, it makes a lot of sense. I've done these loans for enough investors, and I see how much they're making. I see their cost basis, and it makes it extremely attractive as a consideration because the cost basis is so much lower than a multifamily project. And usually you're building these out in the county, so the stipulations are far less than if you're building an A-class, in the city, right? And so you start to think about cycle time to build it, cost basis, and yield. That's why, like my client's cap rate here, that for the one in South Texas was so high, because all of these factors are imputed into that. And because the average yield on a multifamily is 7, 9, 10%, so his yield was double that. And it's because of these things. So I think that for your followers, for your investment community, it's a good thing to look at, because whether it's ground up construction or you're trying to buy an existing one, if it's done right, I think it can be done very well, Daniel.
So in this current environment, if you are talking to real estate investors, and you are, what advice can you give them for really navigating this COVID-19 environment? What do you have to say to people that are looking for their own deals, and what advice can you give?
Well, I mean, my thinking right now is to save your money. Have cash, get ready just in case there's a haircut to the market. Because I don't know if you were around in 2008. I was, and there was a massive haircut to real estate, and I picked up some good deals at that time. I also lost some good opportunities too. So I would say be on the lookout, because I really believe that I mean, obviously none of us know for sure how long this is going to go or what's going to happen 100%. We have ideas and expectations, but, I would say get your funding in line, whether it's through whoever your current lenders are, or if you want to reach out to us. But let's get your proof of funds, all of your approvals ready, and get your cash on the sidelines. It's like what Warren Buffett talks about, that it's hard to hit an antelope if you don't have a loaded gun. So, and you have to have a loaded gun, which is your capital, your funding, in the event that an opportunity, and a seller capitulates and you need to step in and pick it up. So, because that's what could happen, if this thing goes into the summer or the fall and deals aren't happening, and we have Wall Street frozen like it is right now, that could happen. And the people that have money that can pick up deals and opportunities I think are really going to prevail very well.
Yep. I absolutely agree with that. Which actually brings me back to another topic, which I know we didn't talk about, the Fed. What do you think the ongoing fallout from the Fed stimulus packages are going to be? How do you think that's going to play into the current economic environment?
Well, you mean like with the SBA and the PPP and all that, like in the buying?
The SBA loans, but also just the return to quantitative easing.
Oh yeah.
And what sort of effect is that going to have on property evaluations over the next
that's a good question. They're supposedly they're buying a bunch of the debt right now, a bunch of the bonds and everything. And I haven't. So we do owner occupied too, right? FHA, VA, USDA, conventional, and we haven't seen really any easing on that side, because what's happened is I think a lot of these servicers are getting crushed right now because people aren't making their payments. And supposedly there's supposed to be some relief from Ginnie Mae that hasn't really translated yet from what I can see. And I think that their intentions are good, but it's really going to be hard to tell if they continue to buy debt and they are able to pump liquidity back into the marketplace, into the capital markets. I think that's very, very good. And if they can get people back to work, obviously that comes with the health and the vaccine, or however a lot of this ties into what does this look like? Is it going to be like how it is in Wuhan right now, where people do go back to work, and but there's a lot of safeguards in place for health and treatment. Like right now, I don't know if you've seen in some of the videos, like in China, before you go into a store, they scan your forehead, check your temperature before they let you into a Starbucks or a McDonald's, right?
Mm-hmm.
We have to get back to a working environment. I think that if that happens, then property values could somewhat stabilize, but there's a lot of unknowns right now with what that's going to look like and how long that's going to take. So I'm playing it more conservative, Daniel. I think that their intentions are very good. I think that they were a little slow to respond personally. I think that there was a lag time there with some of this stuff. And I think that this year, just from where I'm sitting, I think it's going to be a tough year. I think it's going to be a tough year. I don't have I know some of these pundits and advocates are saying that, Q4 is going to be optimistic. I'm hoping for that. But I also have to plan for, realistic expectations that something bad could happen or worse.
Absolutely. And
so you have to have cash on the sidelines because you don't know for sure. And so I'm not, I'm very optimistic. I'm very positive. You know my story, but I think that you have to be cautiously optimistic right now. Very cautiously.
Mm-hmm. Now, like all other times, and maybe more so than other times, being a conservative underwriter and having cash on the sidelines, making sure you make provisions for that rainy day is very important.
That's right.
All right. Do you have anything else that you want to mention before we go to the lightning round?
No, I love it. I think I'm very honored and privileged to be on the show, so I want to look forward to the next steps with you. So
excellent. All right. On to the lightning round. What's the best part about being a real estate investor?
For me, it's the opportunity to meet other people, build relationships, earn monster income, taking on the risk, the adrenaline, the pump. I love it. I live for it. I mean, I can't go to sleep. I'm a deal junkie. So,
All right, who is your ideal investor or partner?
ideal investor is someone that has significant experience, a lot of liquidity, very enthusiastic, a lot of energy, looking to make deals. Is passionate about real estate. Someone that just can't live without it. Right.
Yep. What's a mistake you've made and what'd you learn from it?
Yes, a very good question, Daniel. So, trusting and not verifying, the contractor, trusting and not verifying the partner, not double checking the numbers. So you got to double check everything. Trust but verify.
Yep. And can you recommend a book, a website, a resource, or something that will help us in our investor journey?
Yeah. So let's see here. For investing, what would be a good book to read? Well, I think negotiation, persuasion, anything that there's a what's the one? How to Win Friends and Influence People. Phenomenal book. Highly recommend that. I think that's very
Dale Carnegie.
Yeah, Dale Carnegie. I think that when you're dealing with people, communication is very, very important. I do this with my team all the time. I think that you have to know how to develop rapport, understand people's needs. I think that's one of the best books I've ever read.
Yeah, I actually second that. I went so far as to take one of the Dale Carnegie courses, and
nice.
it was like a 10-week course where we met once a week and went through the book of material. And and it's I mean, you think you know how to talk to people, and you realize you don't.
Yeah,
and so it's a great book.
It is, absolutely.
All right, how can the Win Multifamily listeners get in touch with you?
Yeah, so please, you can go to our website at officialangelochristian.com. That's officialangelochristian.com. And like you said in the beginning, our YouTube is just Angelo Christian. Check out our YouTube channel. We post tons of great videos, content there. Instagram is Official Angelo Christian. Please check us out. Call us. If you have any questions, you need funding in any way, we're here for you.
Excellent. Thank you, Angelo, so much for being on this show.
Absolutely. Thank you.
I feel like we've been drinking from the fire hose here, listening to you talk about LTV rates and different types of deals that you're in the midst of doing. Yeah. And thank you for your information about COVID as well.
Awesome. All right. Thank you so much, Dan. I really appreciate it. Very grateful for being on the show. Take care.
Excellent. I hope you have a winning day.
You too. Take care.
Hello, Win Multifamily listeners. As you know, this podcast is all about learning to work in teams so that you can buy cash-flowing multifamily properties. If you'd like to learn more about that, please click subscribe. If you're interested in the type of investments that we do at Alon Capital, please go to aloncapital.com/investors. That's Alon, AALON, capital.com. We'd like to set up a one-on-one phone call with you to talk about your real estate investment goals. Mm-hmm. Going back to, you mentioned, I'm blanking right here. I'm going to have to edit this because I can't remember what my question was going to be. Why don't I just let you continue for a little bit?
Well, I mean, yeah, I mean, I think the other thing that's also, really powerful is, if, you're looking to, right now, I guess the solution or the takeaway, I know we're going to talk about bridge loans too. We're still
Oh,
actively
that was
making,
it. Bridge loans.
bridge
Yep.
loans. Okay.